Hi, good evening, ladies and gentlemen. Please scan this QR code first. I would love to share with you the updates on the Singapore REITs. Okay, without further ado, let's move on. We have animation to share with you, okay, to tell you what is REITs all about.
REITs, or real estate investment trusts, have risen in popularity as retail investors benefit from the opportunity of investing in income-producing real estate without having to own or manage physical properties. However, despite the compelling benefits, investors can also run the risk of choosing the wrong REIT. REITs that are badly managed or frequently dilute unit holdings can cause investors to face falling yield income or dilution of yield. On the other hand, quality REITs have the potential to grow when their strong sponsors inject yield-accretive assets into the REIT. As a regional leader in REITs investing, we have been helping investors seek out high-quality REITs with sustainable yields, potential long-term capital appreciation, and have strong sponsors, thereby avoiding weak REITs and their dilutive corporate actions. Our Phillip Singapore Real Estate Income Fund focuses on the S-REITs space and is actively managed such that the fund manager can tactically position the portfolio to the changing macro environment. Our Phillip SGX APAC Dividend Leaders REIT ETF is a passively...
Okay, so I will stop right here, right? So all in all, Phillip Capital Management is an asset management arm of Phillip Capital Group. We are managing about 430 million worth of REITs in across the Asia Pacific region, predominantly Singapore as well as Hong Kong and Australia. Real estate investment trust, as you may know, government have done a few measures, all right, as well as came out of budget last year, all right, amounted to 100 billion, and then this year they said no more kind of financial assistance. We are actually focused on others measure. All right, so REITs investment, the benefit, as you may know, inflation is happening all around the world. Same goes to Singapore. Singapore property price for the past few months has been a bit at the upward trend. Back to US, property prices actually gone up about 20%. Real estate investment trust, the benefit, as you may know, is liquid and flexible. You don't have to worry about the stamp duty, lock-in period, cooling measure here and there. You can catch up anytime, okay? You're not to worry about the rental yield. For example, you invest into the, let's say, condo, residential property. Now, at the moment, what is your yield yet? You are getting is about less than 3%. You have peace of mind as well. You don't have to worry about the plumbing, roof leaking issue, property maintenance related issue. Regular income, yield of 5%, 4-5% per annum. Yeah, is it good enough? I think is, in tandem with the inflation rate as well as the interest rate that we are getting. So it's quite fair. Also, bear in mind that Singapore REIT is one of the best in the world in terms of quality investment, in terms of assets as well. Okay, so three things you need to look at. You need to look at the sponsor, who behind it. Okay, the parent sponsor. Why? Strong and quality sponsor tend to provide financial or asset injection. Okay, quality sponsor like who Capital Land that own the Capital Mall Trust, and now they merged together already. All right, so they have this good, strong financial, good balance sheet, as well as the asset injection. All right, so this is very important. So if the sponsor is not strong enough, so you won't have an opportunity to uplift the value of the property as well as the value of the REITs. The regulatory framework also very important. Okay, Singapore law it allows is obligated. Okay, the managers, the asset manager, to pay out 90% of the earnings to investor. All right, so that they can qualify for the tax incentive. There's a leverage limit now increased to 50% from the previous level 45. Whereas Australian peers or Australian REITs operators, their gearing ratio is about 25%. So it's the catalyst in the prospect. All right. As you may know, Asian countries been developing as urbanized. So more and more asset will be injected into the REITs. More and more opportunity. Now we're talking about S REITs. The next 5 years will be C REIT. What means C? China REIT. Okay. But China REIT, you got to look at their valuation, because China, the valuation is a bit wow. So as a glance, what is happening in the region, the charts to show you here is that the below one, the table, is to show you the regulatory regime regarded as a very conducive among the country in Asia. That's why a lot of foreign REITs operator wanted to list their Singapore. So we, SGX has managed to attract more and more US REIT, and then hopefully one day we'll see China REIT coming in. So this is a legislative comparison. GDP forecast, why it's very important, because it's actually a proxy to Singapore economy. Last year, we see -6%. This year, we hope to achieve 6%. But because of two-time phase 2, we got to forecast again, maybe below 5%, or we predict 5 to 6% this year. Table below to show you there's a recovery story. This time round, what we see here is a big V, meaning to say the recovery will take place at a slower pace. You think that end of the year, or we think the end of the year, everything will be recovered. We see the improvement in terms of the businesses. So we also see some of the REITs operator like hotel is not at the recovery stage yet. Okay, so what's happening? So, okay, let's move on. Singapore REITs, as you may know, we have about 43 REITs at the moment listed on SGX. All these shopping mall, Vivo City, 1 million square feet per lettable area, all these worth about what, 3 billion Sing dollar. Okay, so one of the crown jewel under this CapitaLand. All right, so it has a very, very significant value in terms of value, and also a crown jewel asset held by our Singapore REITs. So Singapore REITs also has a global exposure. Only 12% is focused on Singapore asset. 40% is coming from US, China, elsewhere. 47 is actually, we have a mixture of Singapore as well as overseas asset. Important, yes, important, because when you invest in Singapore REIT, you are exposed to diversify, you're exposed to global asset. Currently, we're about 42 because of the merger. Market cap is about 100 B. Average price to book is 1 time. 1 time meaning to say is the fair value. It's below 1 is good buy. Trust have a diversified portfolio. Offices is about 15, right? Hospitality 13. Okay, office, hospitality, diversified. Diversified is a shopping mall plus the offices. Okay. 3% specialized. What does it mean? It's a data center, they call it. All right. So let's look at the dividend yield for per sectors. The data center has been coming down. Hospitality, you know that what's happening. Hospitality is a hotel. The 5-star hotel operators, they are having a winter now. All right. The winter will prolong until end of the year. So this serves as a guide. Okay. You can see range from 3% to 7%. Yield spread is actually your opportunity cost of this. You invest into REITs. Your dividend is, let's say, 5%. You invest into the risk-free paper bond, which is a government bond, risk-free. So let's say 0.9. So what is your yield spread? 5 minus 0.9, you've got about 4%. So the larger, the better. So this to show you more and more high net worth people allocated into their real estate, into their portfolio. Because it's quite stable, very, very stable. All right. REITs has outperformed the general markets. Okay, the importance of dividend is to provide the regular income. So regular income, it allows you to compound your investment returns. Okay, and then bear in mind that our fund, we don't pay out of capital. The dividends actually we receive from the REITs, or from the REITs that we invest. We don't simply declare dividend out of capital. Australia, yeah, it's a retiree market. You can see it makes up. Okay, dividend return makes up about 90% or 85%. Okay, Singapore, this part is growing. We see it will go up to 70-75% in 5 years to come. Okay, and then these charts to show you the correlations now. Okay, it's less correlated to the bond, less correlated to the equity, so that it serves as a good as a diversifying tool for your investment. This is not to confuse you. Look at this PB, price to book. Okay, just now I share with you, 1 is fair value, below 1 is a good buy. The lower the better, right? Okay, so above 1 is overvalue. This is the guide. This is a guide. Okay, all right. Then the other one you need to look at this number is that the debt over asset. The lower, the better. All right. That means they don't print too much of the IOU. They don't owe so much money. They don't leverage gearing and all this. Those are below 30%, we will give them a big hand now, but I don't think so. They're mostly at 33 or above 30%. Okay. Those above 40%, you will tell them, hey, hello, watch your back, right? This is how we trying to share with you. All right. So these are the numbers that hide below this the whatever financial reports. So it's our job, okay, as a fund manager, okay, need to dig this thing out and then read it properly. All right. Okay. So REIT sector last year, the only sectors that growing is only logistic, right? The retail all down. Okay, GDP also down, offices also down. Retail sector, as you can see during the lockdown, the drop of visitors, okay, they are basically dropped 60%. So last year you can see the cut in the dividend per unit. They call it DPU. Don't get confused. Don't get worried or scared about this jargon. Dividend per unit. Okay, one unit, how much dividend they pay out. There's a cut. Like for example, commercial capital land. They also revise rental, and then of course they also give a rental rebate. So resulted about 20-25% cut in the dividends. Like for example, they pay 4%, 25% drop is 3%. Still paying. The government also may allow them to defer the payment of the dividends. So retail sector, if you look at the tendency discontinue, this is what we see also. The impact is coming in. More and more people close shop, some people bankrupt and all this. Cash flow mismatch already started happen. So that's why the dividend came down 9 months ago. Shop traffic, okay, you can see it's terrible. It's circuit breaker, and then phase 2 opening, phase 3 start coming up. Then it's again now it came down a fair bit about this level. So operating environment in the Singapore retail segment, you can see leisure and entertainment down 54%. What grow was the home furnishing, okay, and then supermarket like Sheng Siong and all this. Books and stationery, yeah, because it's a math. So steady growth. So those are at the positive. They have become a very, very significant numbers. Whereas F&B, departmental store, these are the laggards. Okay. Last year we put end of 2020. Now this year we put end of 2021. Maybe next year end of 2022. Okay, it happens. Drop. Okay, revenue all drop. Operating environment in the hotel segment. You see, the visitor we used to receive 19 million, the third largest visitor arrival in Singapore. Second is Malaysia, 28 million, 28 million. We have a 19 million visitors. But last year, this year, 0.1 only, 100,000. So it's quite bad for this sector. Don't touch. Don't touch. So far, yeah, it relates to what? Relates to SIA. It relates to all these hotel operators. Impact on the global tourism and hospitality industry, it's terrible. It's terrible. So the uncertainty, until 2025. I mean, for this part. So it's actually quite scary. So, but let's just hold on to it. This is the scenario that we would like to share with you, not to scare you. All right. So this is the inbound arrivals by the scenario. Okay. Hospital sector supply, we forget about it because whatever plan 2022 and onwards, don't put too much hope in this hospitality. All right. So next, we move on to the office segment. Office segment is still hovering quite well. But nonetheless, we also see some of the tenants try to downsize their tenancy as well as the rental. They try to save some cost. But the Grade A area in the financial district, like here and as well as the Raffles Place, still expanding, especially those are in stockbroking, those are in fund management and banking sector. Like our case, we're expanding. Field security also expanding. So yeah, we try to take opportunity to grab some of the offices space with some bargain. The rise of the online F&B, but it's actually benefiting who? The centralized kitchen. So okay, the rise of but the offices rental is actually it came down from the 2020, and then now it's about at this range, okay, the price of the rental is about 10 to $11 per square feet. It's still quite high lah, compared to the before that, 2017. Okay, business park is still quite good because a lot of fintech, a lot of IoT companies and startup has been set up in Singapore. So the demand is still steady, quite steady. Operating the environment in Singapore is that you look at the occupancy rate. Okay, the occupancy rate is about 90%. Okay, for the office. Supply demand, we see the demand is coming down. It's coming down for the grade A as well as grade B. Okay, nonetheless, it's still higher than 2017. What turns around was the third quarter of 2017. The sector was up. Commercial sector, Capital Spring is TOP this year, and then the AXA Tower redevelopment, and then Fuji Xerox as well, redevelopment. So these are the new so-called new asset, new property will be offered. And also we see more and more Chinese fintech companies coming into Singapore. So they take up whatever vacuum left by some foreign company, but it's actually very limited, because the grade A one in Shenton Bay area is still limited, very limited. Industrial sectors, okay, look at the business park. Some business park, some they convert the warehouse into the data center. The supply is actually not much, because this year 2021 there's no new supply. So business park demand will stay high. Industrial stock occupancy rate is about 90%, still holding quite well. So they are actually facing a boom time. So let's move on to the Phillip Singapore Real Estate Income Fund. This fund, we launched it in 2011. We have a Thai pension fund that invests into this fund. They love our Singapore's property investment strategy. So over time, it has proven that it's a good investment tool. Okay, you receive dividend every 3 months. Up and down the cycle, you make money from there. If let's say next week, touch wood, the market came down, so you just go in and buy, because it has already proven it go up as well as go down. When the market is not doing well, give you an opportunity to go in. So long-term trend is actually at the upward trend. This chart is to show you, we are at the larger V shape of recovery. This was a .com. It was a SARS was here. Okay, you see larger V. Then this was a global financial crisis. So we were having a larger V as well. Okay, DPU, dividend per unit deferment, up to 12 months. But most of the operators, they fulfill that lah. Okay, all right. They don't have to extend their announcement of the dividend. Highly leveraged limit already mentioned here. Okay, up to 50%. But they have to qualify the deferral of this interest rate coverage ratio. All of the 42 operators are above 3%, 3 times. So they are qualified actually. Okay, they can go, the higher the leverage limit, the lower the ICR. Refinance risk. Okay, refinancing risk, equity arising risk remain low because our interest rate is low. All right, so we don't see the repeat of this GFC scenario. Right? You can see the leverage gearing ratio limit of the REITs operator. Who is the highest? ARA lah, ARA Logistics, the highest. Who is the lowest? Then you can see this. That is how we see the operators, whether their gearing ratio is up to the sky limit or not. Okay, sector gearing ratio 30% is healthy. Okay, asset value are likely to remain stable. So REITs with the US exposure, because US shows some strong recovery. So we just highlight here. Okay, they actually do perform quite well. Some of, not all. So because a lot of US property are not that great, because they are at the second tier city. So then that's why the demand wasn't good. All right. So key takeaway: road to recovery and normalcy, but we have been hit by those on and off the infections. Whatever cluster was before that was KTV, and then Jurong Fishery Port cluster. We wouldn't know what else. Maybe the Nature Park cluster or Kopitiam cluster. So we got to live with the virus together. Okay, we got to learn how to live with it. Okay, actually we are at the road to recovery, right? Because of the vaccinations, and we see here manufacturing is still leading. Digitalization, weak labor market is happening. Singapore GDP, hopefully we can hit 5%. But some operators have shown some improvement, like Suntec and all these, 20% improve. Okay, so will it be similar to 2008 global financial crisis? No, okay, because most of the operator has a stronger balance sheet now. All right, so we look at the long-term opportunity in the logistic, data center, business park, and healthcare sector. Long-term buying opportunity, we still buying. If let's say the market came down, okay, let's say come down about, let's say 10% in 1 month time, just relax, just wait, then you just go in. No, not necessary for you to hurry to go in now or today or tomorrow. No, our advice is we are here for long term. Don't worry about you must buy now. No, but if let's say your portfolio you made 20% in this fund, so you sell, I think you should sell. All right, then wait. Okay, wait for the opportunity and come in. All right, so we prefer REITs with a conservative and healthy balance sheet, okay, and a strong parent. Stable Sing dollar, yeah, and our economy as key factors that foreigner love it. Post-pandemic, we already start talking about it. Supermarket, online shopping, and all this payment processing is actually good for the business part. M&A is continue. Okay, so this is the activity in concluded last year, end of last year, and then some is still got ongoing. This is the property exercise acquisition in 2021, this year, year to date, up to June. Like Parkway also buying some nursing home in Japan. I think more and more REITs operator will buy the so-called elderly care. It was very popular back in 10 years ago when some private equity or some pension, like Korean pension, is going heavily, South Korea, going heavily into the pension home, elderly care home in 2014 before that. Yeah, so we are a bit behind but the curve, but I think it's happening now. Okay, Phillip Singapore Real Estate Income Fund just declared dividend payout last month, so 4.2, 4.3%. So we pay dividend 4 times a year. All right, so it has a retail industry. Retail is there position the recovery, so maybe we miss a bit. Okay, we still have some hospitality where Escort and all this, but not much, about 5%, 5-6%. Okay, then we just give you hypothetically the portfolio A and portfolio B. One is with S-REIT, one is without S-REIT. Portfolio is with S-REIT. You can see the return is higher. Okay, those with S-REIT, the volatility is lower, and then the dividend yield is higher. So it's proven. It's proven as a good income strategy, income tools. REITs is like we have a REITs fund, ETF also managed by PCM, Phillip Capital Management, and we actually manage more than 400 million worth of REITs across the region.